Welcome back to the Deep Dive. Today we're diving into a topic that, well, it inspires and sometimes maybe intimidates. Building wealth from the ground up.
hmm
Many of us grow up believing that significant wealth is primarily inherited, or it's all about who you know, those powerful connections.
Right, that old idea you need to be born into it or have the right network already.
Exactly. But that assumption, it might actually be holding you back because, honestly, the data tells a much more inspiring story.
It really does. A 2019 report by WealthX found something pretty startling, actually. An incredible 67.7% of the world's ultra-wealthy people, we're talking folks with $30 million or more,
Wow.
yeah, they're actually self-made.
67%.
67.7, yeah. And what's even more interesting is that number is growing. It jumped almost 10% in just the 1 year from 2019 to 2020.
So it's not just possible, it's becoming more common.
Precisely. It really shows that building wealth from scratch, well, it defies a lot of those old perceptions we have.
Okay, that 67.7% figure is genuinely motivating. It really flips the script. So if you're not starting with a big inheritance, where do our sources say this journey actually begins? Is there like a common first step philosophy?
But T.R. Kलकर, the author of Secrets of the Millionaire Mind, he puts it really simply. Rich people are committed to being rich.
Committed, not just wanting it.
Exactly. It's not a casual wish. It's like this unwavering commitment. And that internal drive, that's really where the journey starts. Lots of experts say true wealth isn't just about the dollars. It's about a strong internal foundation. Think commitment, courage, character, clarity, creativity.
Okay.
And Darius Farrow points out that your mindset, that's the very first thing that needs to shift for any big change. He talks about protecting a rich mindset, seeing opportunities where others just see problems.
Protecting your mindset. I like that. Like a mental shield almost.
Yeah.
But what does that actually mean day to day? And how does someone like Robert Allen, the real estate guy, connect that to actually building wealth?
Yeah, Allen echoes this. He says, all wealth starts inside you. And it's fueled by that commitment, plus chutzpah, boldness,
Right.
clarity on your goals, and definitely creativity in finding solutions. So, protecting your mindset in practice, it means actively staying optimistic, learning from failures instead of, letting them crush you,
Like,
and constantly seeking knowledge. It means seeing a market dip not as a disaster, but maybe as a buying opportunity. This inner state is just so crucial because it dictates how you react and if you even see the paths to wealth.
so get the inner game strong first.
Yeah.
Then what's the first actual move? Seems like before you even earn that first dollar towards wealth,
Yeah.
you need to invest in your own education.
Spot on. Robert Kiyosaki, Rich Dad, Poor Dad, he urges us to invest time in your financial education to build an arc with a solid foundation. And for our listeners, this isn't just reading one book. It's about continuously sharpening your understanding of how money really works. Getting familiar not just with income and expenses, but really understanding how to calculate and grow your net worth. That's the real measure, right?
Yeah, the bottom line.
And understanding ROI, return on investment, how passive income works, what financial independence actually means for you.
And maybe a quick caution here. Because there's so much info out there now, it's crucial to stick to reputable sources.
Yeah.
Right? It's easy to get bad advice.
Oh, absolutely. Due diligence is key. So once you're building that knowledge, got the mindset right, what's the next step for building that financial runway? Because it's tough to build wealth from nothing without some consistent income flowing in.
True. Get rich quick usually doesn't last.
Exactly. Sustainable wealth comes from creating long-term value. Brian Tracy says all wealth comes from adding value. So if you're an employee, that means boosting your skills hard and soft to get promoted or find better jobs.
Yeah.
And if you own a small business, it's about really understanding your market, innovating, offering more value to get more customers and revenue.
Okay, so income's flowing. Then budgeting becomes like your financial compass, that 50.322.2 rule, 50% needs, 30% wants, 20% saving investing. That's a common starting point. But for folks aiming higher, for real financial freedom, how do you push past that 20%? Any extreme saving hacks?
Yeah, that's where that commitment really kicks in. The 50.30.20 is solid, but the FIRE movement, financial independence, retire early, they talk about extreme saving.
I've heard of FIRE.
Jacob Lunkfisker, one of the founders, famously retired at 33. How?
Yeah.
By investing 60 to 80% of his income.
60 to 80%. Wow.
Yeah, and apparently he lives on just $7,000 a year now. His approach isn't about feeling deprived, though. It's more about building or creating what you need instead of just buying it.
Interesting shift.
So even if you're already budgeting, you can find new ways. cooking at home way more often, optimizing every single subscription, maybe even renegotiating rent or your mortgage. Jeff Bezos actually said, frugality drives innovation. It pushes you to find solutions.
60 to 80% still sounds intense. What's the biggest mental block people hit when trying to cut spending that much? And how do you get past it?
It's often that feeling of giving something up right now, fear of missing out. The key is reframing it. It's not giving up, it's gaining future freedom.
Okay, focus on the goal.
Exactly. Like that Dallas Fed example of Gabby tracking her spending. Even small changes, when you see how they add up toward your goal, build momentum. It feels like conscious choice, not sacrifice.
That makes sense. And talking about security, the emergency fund,
None.
non-negotiable, right? But how does it become more than just a safety net, like a strategic tool for wealth builders?
Yeah, beyond just peace of mind, it strategically stops you from wrecking your long-term plans. If you have a job loss or a big medical bill, you use the fund, not high-interest credit cards or selling investments at the wrong time.
Right, it protects your actual investment.
Exactly. So your portfolio keeps growing undisturbed. Planners usually say 3 to 6 months of living expenses. It buys you time and options, not just covers costs.
It's easy to focus on building, but protecting that wealth is just as vital. Insurance comes in here. What's maybe a subtle aspect of insurance that self-made folks get right beyond just basic health or car insurance?
It's understanding strategic coverage versus just buying everything. They realize their biggest asset is often their ability to earn. So protecting that with things like term life, disability insurance, alongside the essentials like health and home auto is key.
Protecting the income stream itself.
Precisely. Like Jack Ma said, buying insurance cannot change your life, but it prevents your life from being changed. Focus on genuine risks, not just collecting policies.
Okay, wealth protected. Now, let's talk growth. We mentioned lowering expenses, but what about the other side, turning up the income tap?
Yeah, you've got those two levers. Cut expenses or grow income. For employees, it's about continuous development, improving skills, both technical and soft skills like negotiation, leadership, to climb the ladder or get better offers.
Always be learning.
Right. And for business owners, it's digging deep into market needs, innovating, providing better value to grow that market share and revenue, constantly evolving what you offer.
And this leads nicely into where wealth can really start to accelerate. Passive income. Making money while you sleep. That Warren Buffett quote is famous for a reason, isn't it?
Oh, yeah. If you don't find a way to make money while you sleep, you will work until you die. Pretty blunt. And we're talking two main types here. There's investment passive income, where your money does the work. We'll get to that. And then there's non-investment passive income. You do some work up front, set something up, and then it generates income without you constantly being there.
Especially now, in the digital age, right?
Yeah, exactly. The digital revolution has just flung the doors open. Almost anyone can use online platforms, free tools, even AI now. The main idea is create something once, or set up a system once, and it keeps delivering value and bringing in cash.
Like what specifically?
Well, think about leveraging your expertise. Create and sell digital products, ebooks, video courses, maybe paid webinars. You build it once, it keeps selling. Or blogging with ads, affiliate marketing, where you promote other people's stuff for a commission.
And automated dropshipping seems huge, too. Running an online store without actually touching the products.
Yeah.
How do things like AI and Amazon make that realistic for someone starting small?
It really levels the playing field. AI tools can help find products that are in demand but don't have tons of sellers. Amazon, the whole system, their metrics, algorithms, fulfillment services, lets you leverage their infrastructure.
See, I find the product, they handle the rest.
Largely, yeah. The sources mention people starting with maybe $100, $115, finding something like lawnmower blades for $5 and selling them for $28, $45. Amazon ships it. You manage the listings, the sourcing. Many sellers apparently see profit in year one. Some even go full-time just doing that. Low startup costs, smart sourcing.
That's a great example of tech leverage.
Yeah.
Beyond digital stuff, where else can people find these non-investment passive streams? Using assets they might already have.
Oh, there are tons of creative ways. Think about premium space sharing. Got extra space, maybe climate-controlled storage for wine. People pay $200, $500 a month for that. Or specialty vehicle storage, $100 to $1,000 a month.
Wow, okay.
Even leasing land for solar or wind farms. That can bring in thousands per acre or per turbine annually, long-term income. Sometimes you can still farm around it. Or just renting out things you own but don't use all the time, like power tools or even your car, for $40 and $100 a day.
Using underutilized assets.
Exactly. The big theme is the barrier to entry is way lower now. Anyone can potentially create multiple income streams with some initial effort and creativity.
It really highlights how the digital age opens doors. Okay, so you've boosted income, got savings, maybe some passive streams going. The next giant leap is strategic investing, right? Making money work for you.
This is where the real wealth building happens. Every self-made millionaire got there through smart investments. It means your money is out there, earning profit from others' work, even while you're asleep.
And let's be clear, putting money in a regular savings account, that's generally not investing, is it?
Definitely not. The interest rates are usually so low, often under 1%, that inflation just eats away at your purchasing power. Savings accounts are really just for that emergency fund.
So for investing, what's the mindset?
Long-term perspective is absolutely vital. Don't try to time the market, jumping in and out. Statistically, the market goes up way more often than it goes down, like 74% of the time versus 26%. Long-term investors almost always win.
Like Peter Lynch said.
Exactly. More people lose money waiting for corrections and anticipating corrections than the actual corrections. Just stay invested.
And within investing, passive investing seems to be gaining a lot of traction over active strategies. Why is that? What's the core appeal?
Well, for most people, the advantages are pretty clear. Passive investing is usually cheaper, fewer fees, fewer taxes from trading. It's less risky because you're diversified across the whole market or large parts of it. It's more transparent. And honestly, it often ends up being more profitable long term because you're just capturing the market's return.
So trying to beat the market is tough.
Very tough. Even Warren Buffett said the passive group, the know-nothings, must win. For most of us, just participating broadly and consistently is the smarter path.
Okay, passive is the way. What are some of the best tools or opportunities within passive investing, beyond just diversification?
ETFs, exchange-traded funds, are fantastic. They're like baskets of investments. You can buy one ETF and instantly own little pieces of hundreds of stocks or bonds or even real estate companies.
So instant diversification, low cost.
Right. You can get stock ETFs covering different markets, company sizes, industries. Bond ETFs are generally less risky than stocks, and mixing them can smooth out the ride for your overall portfolio.
And you mentioned REIT ETFs. Real estate investment trusts. What's unique about those?
REIT ETFs let you invest in companies that own or finance properties, malls, apartments, offices, etc. So you get real estate exposure without actually buying buildings.
Okay. Less hassle.
Yeah. And a big plus. REITs legally have to pay out most of their income, at least 90%, as dividends to shareholders, so they can add a nice income stream to your portfolio. Index funds are also super popular, similar idea, broad exposure, low costs. Very simple for many investors.
Makes sense. And no wealth building talk is complete without retirement accounts, 401k, IRAs. Beyond the tax breaks, what's the strategic edge they offer, especially with compounding?
The strategic edge is huge. First, that 401k match from your employer, that's free money. Always, always get the full match first. It's an instant return.
Can't beat free money.
Nope. Second, the tax advantages of IRAs, traditional grows tax-deferred, Roth withdrawals in retirement are tax-free, are massive over decades. But the real magic is how they turbocharge compounding.
The eighth wonder of the world.
Exactly. Compound interest means your earnings start earning their own earnings. The rule of 72 gives you a quick estimate. Divide 72 by your expected annual return, and that's roughly how many years it takes for your money to double.
So, for our listeners, what's the most powerful takeaway about compounding that maybe goes beyond just start early? Is it consistency, growth rate?
It's really the incredible power of consistent early contributions. Yes, time is crucial, but regularly adding money, even small amounts, just dramatically amplifies the compounding effect. Like the example, a 20-year-old investing just $3,000 a year at 8%, they could have over $1.2 million by 65.
Wow. From $3K a year.
Yeah. The takeaway is that steady, regular investing becomes absolutely monumental over time, especially in those tax-advantaged accounts.
That's incredibly powerful. And to make this easier, especially for beginners, there are tools like robo-advisors. Automation sounds nice, but what's the real behavioral benefit of using them?
The biggest benefit is probably removing emotion from the equation. We humans tend to panic sell or buy high out of fear or greed.
Guilty.
Yeah, we all are sometimes. Robo-advisors use algorithms, often based on modern portfolio theory, to build and maintain a diversified portfolio suited to your risk level. They handle deposits, reinvest dividends, rebalance automatically. It enforces discipline and helps you avoid those costly emotional mistakes.
Keeps you on track. Okay, but what about people starting with debt or very limited funds? Can you really build wealth from nothing if you're technically starting in the red?
You absolutely can, but you have to be smart about priorities. If you have high interest debt, think credit cards, often over 10%, sometimes way overpaying that down needs to be priority number one.
Before investing?
Generally, yes. The return you get from wiping out 18% interest debt is like earning a guaranteed 18% return on your money. It's almost impossible to beat that safely with investment.
That's a really good way to put it. But what about lower interest debt, like mortgages, student loans? How do you balance paying those down versus starting to invest, psychologically and financially?
That's where it gets more nuanced. For lower interest, maybe tax-deductible debt, you can often do both. Paying extra on the loan gives you a guaranteed return, the interest saved. But simultaneously, starting to invest, even small amounts, lets compounding begin its magic.
And psychologically.
There's a big psychological win, too. Investing even a little while you're still chipping away at debt can feel like progress, like a ray of light, as one source put it. It keeps you motivated for the long haul of debt elimination. It keeps the dream alive.
I like that. Okay, final area, real estate. Building a portfolio without a ton of cash sounds impossible to many. How do strategies like house hacking or wholesaling actually work for someone starting small? What are the mechanics?
It's really about ingenuity and leveraging skills, not just cash. House hacking is maybe the most straightforward. Buy a small multi-unit place, live in one unit, rent the others out. The rent helps cover your mortgage, maybe even provides cash flow.
Okay, makes sense.
Bird dogging is basically being a deal finder. You use your network and research skills to find good properties for established investors, and you get paid a finder's fee. No capital needed, just hustle.
Right.
Wholesaling is interesting. You get a property under contract, then you sell the contract itself to another buyer for a profit before you ever actually have to close or take ownership. Again, low capital needed. Master leasing involves leasing a property with an option to buy later, letting you control it and generate cash flow now.
So it's about creativity and people skills too.
Hugely. Robert Allen's famous challenge, send me to any city with $100 and I'll buy real estate in 72 hours, wasn't about the $100. It was about demonstrating that creativity, finding solutions, building trust, negotiating win-win deals. That's often way more important than having a big pile of cash to start.
That's a fantastic reminder. Ingenuity over capital. Okay, let's recap this deep dive. Building wealth from nothing, it's not some myth for the lucky few. It really seems like an achievable journey. It's powered by that deep commitment, solid financial education, those disciplined habits like budgeting and maybe extreme saving, then strategically growing income, finding those multiple streams, and finally, patient, passive investing.
Absolutely. And maybe the biggest takeaway in a world that often just looks at what you own is that real wealth, it truly starts inside you. Your courage, your character, your clarity, your creativity, that internal capital is your most valuable asset.
That's a great way to end it. So thinking about that internal capital, how might focusing on cultivating that unlock material opportunities you haven't even considered, especially now in this digital age? What small step will you take today to invest in that inner wealth? Until next time, keep diving deep.